Investors are on track to sink a jump shot for records despite the government shutdown. Joining me now, Goldman Sachs Private Wealth Management Global Co-Head Meena Flynn. Meena, great. First day of the government shutdown, markets are doing well. How long does that last if the shutdown gets protracted here?
Yeah, wouldn't be expecting that actually the markets react too much to a government shutdown. And as you say, we're at all-time highs. We anticipate that every week that the government is shut down, it's a 15 basis points hit to GDP for this quarter.
Every week?
Every week. But that will be reversed once the government opens up. And so while it's a near-term hit, it's going to get reversed. And so we do think that the markets are going to look through that.
Okay. Well, in essence, what we've seen in the past is that it really doesn't have a huge effect on the markets and on investing. But people need to be on the right path. What is the right path right now?
Yeah, it's definitely top of mind for our clients. You've got markets at all-time highs. You've got valuations at the 10th decile. And our clients are asking us, do we stay invested and what do we do with incremental capital? And our answer is to stay the course. The number one thing that clients need to focus on is portfolio construction. We spend a lot of time on asset allocation upfront and an ongoing basis. And this is to encourage our clients to take enough risk so that they offset inflation on an after-tax, after-spending basis, but also not too much risk that they become uncomfortable in market downdrafts and they sell. And so portfolios are comprised of a ballast of fixed income as well as a good amount of exposure to equities and alternatives. Would also note that wouldn't use necessarily valuation as a signal as it relates to when to exit the market. We've actually been in the 10th decile since December of 2016 from a valuation perspective. Since that time, the market has rallied 200%. So what we're very focused on is earnings.
You don't want to miss the upswing and the rally, and there is momentum right now. So when you look at the risk opportunities, I know everybody has a different risk calculation because there are older people who need to make sure they're in, money preservation, and then there are the younger people who can take more risk. But is there one area that works for just about everybody who's in the market longer than 6 months? Well,
I think one of the things I think you've actually written about is how important it is to try to not to time the market. And so if you actually look over the last 20 years, the market has returned almost 11% on an annualized basis. But if you were out of the market on just the 50 best days over the 20 years, you would be down 2%. And so that message is really about staying the course.
And not doing directional trades or trying to guess. That said, right now, the hottest area, if you say don't short or don't get out of a momentum area, would be technology. Which parts of technology?
Absolutely. And we definitely love innovation, and our clients are overweight technology. They're overweight the picks and shovels, industrials, energy. And it's a sector you don't want to bet against. Earnings in the first half grew almost 30%. And these businesses, if you look at the top 5 tech stocks in the S&P, their ROE is 65%. They have huge moats around their business. They've got significant scale. They're generating a lot of cash flow, and they're able to continue to reinvest in their businesses.
Your, I guess, one-year outlook, 12-month outlook for the S&P is at 7,200 at Goldman. Right now, we're at 6716. So this continues to jump, even though we haven't seen any kind of correction in a long time.
Well, a few things I would say. One is we do think we're probably going to hover around current levels through the end of the year. And then as we start to get more fiscal and monetary stimulus, the weaker dollar, you will continue to see the market move higher towards that 7,200 range. If you look at the last decade, 80% of the market returns have actually been driven by earnings and dividend, not by multiples.
Or headlines.
Or headlines. And so that's why it's really important to keep focused on those earnings.
Meena, I really appreciate what you're bringing to us, because it sounds not an alarm bell, but a focus on, again, long-term investing. But you got to be ready for the bumps and bruises that could come at any given moment.
Absolutely. Definitely have to be able to be in a position where when the market is down, you are staying put or you are buying. When you are at the 10th decile, like we are now, there is an 80% probability that you're going to get a 10% drawdown.
Before we go, though, when is the time to exit?
Well, it's impossible to exit. I think you have to constantly be rebalancing your portfolio. So as you continue to make money in equities and alternatives, you are trimming that and you are putting that into fixed income and keeping that portfolio allocated appropriately.
Rotating. Okay, great to see you.
Thank you.
Meena Flynn, thank you very much.